All right, so we're going to take a look at the 2009 FRQ here. It says, assume that the United States economy is in long-run equilibrium, okay, with a fixed expected inflation rate of 6% and an unemployment rate of 5%. The nominal interest rate is 8%. All right, lots of data. So we're at long run. We're in a long run equilibrium, though. Okay, so we're at long run equilibrium. Using correct label graph of both the short run and long run Phillips curve, and the relevant numbers for the above show long run equilibrium as point A. All right, so we got the Phillips curve here, and to show equilibrium on the Phillips curve, the dot, which represents our economy, is just going to be the intersection there of your long run Phillips curve, which represents the natural rate of unemployment, that 5% that they gave you, and the intersection of the short run Phillips curve. Short run Phillips curve just shows the inverse relationship between inflation and unemployment. And they told us the inflation rate there is 6%. Calculate the real interest rate in the long run. So, all right, we have nominal equals our real plus anticipated inflation. So that means real equals nominal minus anticipated inflation. So if we have a nominal interest rate there of 8% and inflation of 6%, we have 8 minus 6 getting us 2. It's not hard math as long as you know the formula. It's from the memory test there. You guys got that. All right. Assume now that the Federal Reserve decides to target inflation rate of 3%. Okay, so they want inflation. They want inflation of 3%. What open market operation should the Federal Reserve undertake? So with having an expected inflation rate of 6%, they want to target a 3% inflation rate. So we're going to see that they want the economy to shrink a little bit. They want prices to go down. We have currently 6%. They want to bring it down to 3%. So they want the price level to drop. They want the economy to shrink. And we know from the flow chart there that in order to get price levels to go down, to get aggregate demand to go down, to get the economy to contract, the Federal Reserve on the open market, they should sell bonds. If you sell bonds, the money supply shrinks, interest rates go up, there's going to be less spending, and with less spending, drops the price level, drops aggregate demand. So that was a little bit of a tricky one there, but they want you to try and sell the bonds there on the open market. Remember, open market, you buy or sell bonds. D, using the correct little graph of the money market, show how the Federal Reserve's actions you identify in Part C will affect the nominal interest rates. All right, we just stated that straight from the flow chart. So when you sell bonds, it's a contraction. So we're going to see that the money supply decreases, and as the money supply decreases, money becomes more rare, so it becomes more expensive to get it. So your interest rates go up. Remember, money market, nominal interest rates. So interest rates go up, those nominal interest rates go up. It's going to be more expensive to borrow money, so people borrow less money and spend less. That's why you're going to see a drop in prices. How will the interest rate change you identify in Part D affect, aggregate demand in the short run explained. We just did that. It's going to be more expensive to borrow the money. So you're going to see a drop in I sub D and C that they call it interest sensitive consumption spending. So consumption and investment components are components of AD, so AD will go down. F, assume that the Federal Reserve actions is successful. What will happen to each of the following as the economy approaches a new long-run equilibrium? The short-run Phillips curve explain. You're going to see that the short-run Phillips curve is going to shift a little bit to the left there, simply because you have the lower inflation. You have lower inflation, so you're going to see with some inflationary period here, you're going to see that the inflation rate comes down somewhat. The long-run Phillips curve represents that natural rate of unemployment, and the natural rate of unemployment is not going to change if we have a drop in inflation, you're not going to see the blockbuster employee get their job back. The frictional and structural implements do not change. So inflation does decrease, but so that will show the whole curve kind of shifting down or to the left there because of the drop of inflation. But natural rate of unemployment and the long-run Phillips curve not changing. Number 2, assume that as a result of increased political instability, investors move their funds out of the country of Tara. All right, so we're taking money out of Tara. They're not investing in it, okay, for whatever reason. How will this decision by investors affect the international value of Tara's currency in the foreign exchange market? Explain. Okay, so if they're taking their money out, they're not demanding Tara's currency anymore. They don't want it. If you're not demanding something, that means the value of that currency is going to go down. So Tara's currency will depreciate because nobody wants it. They're not investing in it. Using a correct little graph of the local funds market and Tara show the impact of this decision by investors on the real interest rates. So if foreigners are taking their money out of their economy, that means there's going to be a less supply of local funds. Foreigners have the ability to add extra money to the local funds market, or they can take their extra money out of that economy. They're taking their extra money out because of the political instability. So they're saying, nope, we're taking our money back to our own economy. So the extra loanable funds that was in Tara's economy is now leaving. It's going back to a different country. So there's less supply. If there's less supply of something, if something becomes more rare, it should cost more to get it. So the cost of getting money are these interest rates. Remember, if you get a loan, that's for real. So the real interest rates are going up. Given your answer in part B, what will happen to Tara's rate of economic growth? Explain. This is straight from the flow chart. If interest rates go up, it's going to be more expensive to borrow money. And it's more expensive to borrow money. There's going to be less capital formation. So you're going to see a decrease in I sub G, which if there's less capital, there's going to be a decrease in the rate of economic growth. There's not as much I sub G or not as much, we call it capital stock, capital formation, I sub G, all that stuff, same thing. So as I sub G goes down because of the higher interest rates, you're going to see less economic growth. And again, from the flow chart. Looking at, banking system question here, number 3. Assume that the reserve requirement is 20% and banks hold no excess reserves. Assume that Kim deposits $100 of cash from her pocket into a checking account. Calculate each of the following. The maximum dollar amount the commercial bank can initially lend out. Okay, so not the banking system, but the commercial bank itself. The bank has to hold on to a percentage of this deposit. They have to hold on to 20% of that deposit, and then they can lend out the remaining 80% or $80. Remember, banks only have to hold on to a percent there, so 20% of the deposit. Your $20, they can lend out the remaining excess reserves of 80. The total maximum total change in demand deposits in the banking system. Okay, so demand deposits is a little bit different than money, and the max change in money. With demand deposits through the banking system, and whenever you see this phrase banking system, that's your indicator to use the money multiplier. The money multiplier is 1 over the reserve requirement. So max change in deposits in the banking system, the formula is simply your deposit, $100, times 1 over the reserve requirement. So 100 times 1 over 0.2. 1 over 0.2 is 5. So 5 times 100 gets you that magic number of 500. This is different from max change in the money supply. Max change in the money supply is your excess reserves. The excess reserves is what the bank could initially lend out. So your excess reserves were 80. So it'd be 80 times 1 over the reserve requirement. And 80 times 1 over the reserve requirement is going to get us 400. Next one here, we said, assume that the Federal Reserve buys 5 million in government bonds. Okay, bonds, all that money is considered to be excess. With bonds, all money is excess. We're not changing deposits. If there were change in check deposits or demand deposits, then the bank would have to hold on to some of this money in reserves. Because it's bonds, all of this money is considered to be excess. So all of it can be lent out. All of it's excess. As a result, what is the maximum increase in the money supply through the banking system? Okay, so again, we have that phrase banking system. It means we have to multiply times 1 over the reserve requirement, which we learned 1 over 0.2 is 5. So 5 million, because all of this excess, 5 million times 5 gets us 25 million. 25 million. All right, last one here. Let's take a look. Given the increase in the money supply in Part B, what happens to real wages in the short run? So real, if we remember, are nominal minus your inflation. So in the short run, nominal wages aren't really changing. In the long run, they will. So if nominal wages remain constant, assuming that nominal wages remain constant and prices go up, or if there's more inflation because there's so much money out there, your real wages will decline. The reason why is because your real wages fall because of the inflation, the increase in price level. If the Federal Reserve dumping $25 million out there, that's going to cause prices to go up. And prices going up is the same as inflation. So if inflation goes up, you can't buy as much stuff with your money. So that means your real wages will decline. All right, that's questions 1, 2, and 3 for the 2009 FRQ. Hopefully this helps out. All right, take care, guys.